Hi, and welcome to Access to Justice. I'm your host, Heather Malarick of Merrick Law. We're joined today by a very special guest, Kim McDonald of McDonald Advisory. Kim is a financial advisor and insurance advisor with Raymond James Limited. Hi, Kim. How are you doing?
Well, Heather, as you pointed out before we jumped on the podcast, I changed my background. After 2 years of us filming podcasts, I finally dragged my butt back into the downtown core, and this is a portion of my office.
Oh,
so weird.
That's exciting. I thought maybe you just took a snap of your office and you were using that as your background now.
You know, that's actually a great idea to trick people, but I actually am not in my jammy home and I'm back in the office. Not a bad idea, Heather. I like where you're going with that.
You know, something to think about. Yeah. I've noticed that we've just been joined by our other co-host, Evan Clark of Kahane Law. Hi, Evan. How are you doing?
Hey, guys. I'm doing good. Sorry for just dropping in like this. I was on earlier with Kim and really enjoying. I was, first of all, totally shocked by what I saw. I was confused. I was like, what is this new background? Same printer, but different background. And then I had a client emergency. So I had to just disappear without telling her anything. So I'm back.
Okay. Well, welcome back. I am very, very excited to welcome our very special guest today too. Hi, Daryn. We've got Daryn Hobal here. Hi, Daryn. How are you doing?
Hi. Again, thanks for having me, and good to connect with Kim and Heather again. And nice to meet you, Evan.
Yeah, nice to meet you.
Evan, you're the only one who doesn't know Daryn. This is your brief introduction.
Yeah, this is almost every episode. I'm the only one that doesn't know the person. Except, once in a while I bring someone on and you guys don't know them. But no, it's great. And that way, by the way, Daryn, that's a great endorsement if Kim and Heather both like you.
Okay. I don't know if they like me, but I hope so.
We sure do. We sure do. So, Daryn, I understand you're a chartered business valuator, you're a certified financial planner, a licensed commercial real estate appraiser, and you also have a Canadian investment manager designation, as well as being a certified fraud examiner. So lots of expertise in the financial area. What are you going to talk to our guests about today?
Well, I guess what I thought I would do is maybe talk about the world of fraud examination and talk about the association that basically trains fraud examiners, what fraud examiners are, and what I guess the different types of occupational fraud there is out there, and for people practicing family law, what are some things to look out for when you're reviewing financial disclosure and that kind of thing. So so that's what I thought would be a good area to focus on.
And I guess before we launch into the nuts and bolts of that, how did you become interested in fraud? When I saw this expertise in your background, I was super excited to talk to you about it. But how did you come to this topic and to learn so much about it?
Yeah, so it's kind of a long story, but in my previous life, when I was a university student, I actually studied criminology, and I actually was also I was a police cadet for 3 years. I was a sergeant or staff sergeant of the Edmonton Police Cadet Group, and I actually worked for the city police for 2 summers in their Parks Division. And I got to learn actually a lot about law enforcement in those years. And then I kind of I switched majors into business when I was in university, and I kind of left that background. I left that in the rearview mirror, and just before the pandemic, I ended up being referred to a file. It was one of my lawyer clients had a client who had his controller take about $500,000 from him, give or take. It was pretty significant. And the RCMP were involved, and the RCMP basically said, well, you should get a forensic accountant. And I worked in an office of accountants, and I prepare, my whole career has been, well, for the last 15 years has been preparing expert reports. And I thought, well, I've always prepared reports for civil litigation matters, but I've never really prepared reports for criminal situations. So this would have been a first. And anyway, it never ended up going anywhere, but it really got me thinking about, my background, in criminology, and also my finance background that you pointed to. And so I ended up taking, when the pandemic rolled into town, I thought this is a great opportunity to, update my professional credentials a little bit. And I'm, at that time, it looked like I was going to have a lot of time on my hands. So I took a couple of courses through Algonquin College in forensic accounting. And then I ended up enrolling in the CFE program, and it took me about a year. I started that in the spring of 2020, and then I took the 4 exams and got my accreditation in the summer of 2022. So that's kind of what kind of got me into. It was partly because I had the time, because of we were all shut in for a while, and I thought it would be a good time to do something like that. And then also just the blend of my background in, from university in criminology and my finance background, it really seemed like a good crossroads, that program. And I actually found the program very interesting. Basically there was 4, well, I'll just back up. The Association of Certified Fraud Examiners is a large organization. I think there's about 70,000 members across the world. It's an international, and the whole program was really well put together. It involved there was all kinds of chat groups that you could get in and network with literally people from all over the world, from all kinds of different backgrounds. And what you really find in that, with the other students that were involved, is really, really diverse backgrounds. Like, you had a lot of people who were accountants and carried guns to work. And you had people that work at banks and insurance companies that are susceptible to fraud, and really monitoring their the activity. You had police officers, internal auditors, like people like me, sole practitioners, and there's a number of CBDs in Canada that are also fraud examiners. And so basically the course is administered in 4 parts. There's one part is financial transactions and fraud schemes. And that, there's a lot, quite a bit of accounting and financial statement analysis in that section. And then, which was new, and then laying out the fraud tree, which I'll talk about in a second, and the different schemes that are out there. And then there's a portion on law, and it was a little different than I think you would take in Canada, because the student body is from all over the world. So there's, people from different, different legal paradigms, but, they broke down what the issues are in fraud examination and the law. Then there was a section on investigations, and which involved like how you plan a fraud investigation, all the way through to how you collect evidence, collecting digital evidence, how you interview people, how you interview people with the intent of getting an admission of wrongdoing. And then the other one was the last module was on prevention and deterrence. And a lot of people who are in-house fraud examiners, they're looking to protect their businesses from fraud, which is it's a huge deal. Like you just if you read the papers, like every day you're hearing organizations that are getting bilked out of millions and millions of dollars. So it's a huge problem in our world, on many levels. So so that's kind of how that evolved, and So what I thought I would do is I do have a. Did you get those exhibits that I sent you?
We sure did. Yes.
Are you able to post them, or do you want me to do that?
We can screen share them for sure, Daryn. We can get those up.
So, what we're talking about is occupational fraud, and occupational fraud, I'll give you the exact definition. It's defined as the use of one's occupation for personal enrichment through the deliberate misuse or misapplication of the employing of an organization's resources or assets. Simply stated, occupational frauds are those in which an employee, manager, officer, or an owner of an organization commits a fraud to the organization's detriment. And that's the definition of organizational fraud. And within the what you've just put up there is this is something that this is an exhibit from the ACFE fraud manual, and what it is, it's the fraud tree, and it really classifies three types of occupational fraud. One is, the first one is corruption, and basically what corruption is, it's a situation where an employee misuses his or her influence in a business transaction in a way that violates her duty to the employer in order to gain a direct or indirect benefit. The other category is asset misappropriation, and this is a scheme where an employee steals or misuses the assets or resources for an organization. And I guess what I thought we'd talk about mostly is financial statement fraud. And actually, financial statement fraud, in terms of the if you were to quantify the losses, this is where the biggest money gets lost. If you look in the stock market, for example, Kim would be familiar with this. If you look back, for example, in year 2000, you saw companies just blow right up because of fraudulent activity. If you look at Nortel and Enron, all these companies where there was just billions of dollars of market capitalization wiped out, was because of financial statement fraud. And so in terms of, in terms of the number of frauds that happen, you probably see more asset misappropriate fraud, but they tend to be smaller. People ripping off their employer for $100 or taking a little bit of money from the till or whatever. But generally speaking, with financial statement fraud, you can have losses that are huge. So the definition of financial statement fraud, it's the deliberate misrepresentation of the financial condition of an enterprise accomplished through the intentional misstatement or omission of amounts or disclosures in the financial statements to deceive financial statement users.
So kind of like Nortel?
100%. Yeah.
What guys are doing?
Yeah, and so there's another one, slide like this where I just have the fraud tree for financial statements, and maybe pull that one, and we'll maybe talk about that, and we'll talk about, I guess, financial statement fraud in the context of what to look for in your practice when you're reviewing financial statements, and some things to be aware of. So I think when you're probably in your law practices, you're probably often given financial statements for figuring out child support or property matters. And when you get financial statements, I think one of the first thing you want to do is identify what kind of financial statements you're getting. There's three types of financial statements that are really differentiated based on the level of assurance that's provided in the statement, and the responsibility and how much corroboration the accountant has done when he's issued the statements. So the first financial statement it's probably 80%. I don't know what the percentages are, but most of the time, that's what I'm coming across is notice to readers, or they actually call them compilations now. They've changed the names, and some of the standards for those financial statements have changed. But really, with the compilation financial statement, the accountant has done nothing to corroborate the information. It's his client gives them information. And they don't do a lot of third-party verification. They don't do any auditing. It's basically garbage in, garbage out. Now, if all the information is presented properly to the accountant, and accounting principles are followed, you should end up with the same financial statements. But sometimes that happens and sometimes it don't. You just have to be aware of the level of assurance that's being provided. The second
Daryn,
type of...
Sorry, can I interrupt for just 1 second?
Sure,
and just to back you up for one moment before we go on with the next level of assurance. For our listeners who aren't familiar with the concept of a financial statement, could you let them know in a sentence or two what is a financial statement of a company? Yeah,
so a financial statement has usually two parts. There's a balance sheet, and what a balance sheet is, it's on your left-hand side, it's your assets, and then on the right-hand side, it's how those assets are paid for. So and you have basically the assets are paid for either through borrowing from a bank or another third party, or the equity that that is there. So if you have, let's say you have a simple company, all it has is a house with a mortgage. So you'd have the house on the left side of the balance sheet, and then on the right-hand side, you would have the mortgage and the down payment. So you have your liabilities and equity, how the right side is paid for.
They have to be the same. They have to be the same. That's why it's a balance sheet. The number at the bottom has to be the same, right? Yeah, or if they don't, you got to ask some questions. But ideally, yeah, they should. The right and the left should equal, right? And then the other statement that you'll have is an income statement, and so a balance sheet is taken at a point in time, where the income statement is the performance. The financial performance of the organization over a period of time. So what you'll have on the top line is your revenues, your sales, and then you'll have usually your cost of sales, which is if you're making something, your materials, your direct wages, and then you have your gross profit, and then below that you have your fixed expenses like your rent and your insurance, and then gets you to your net profit. And those are basically, in a nutshell, what your typical financial statements include.
Okay. So what a company owns, what they owe, and what they're earning, more or less.
Yeah, that's exactly what it is. And it's and so when you go to an accountant, they like I said, they prepare the financial statements based on different levels of assurance. And the level of assurance is often dependent on who the users are. So in most small companies, typically the users are Revenue Canada. They're basically preparing those financial statements for filing their taxes, and that's it. So they're not really concerned about shareholders. They're just usually preparing the financial statements for filing taxes. When you get into the next level of financial statements, you get into what's called a review, and typically a company is required to provide a reviewed financial statements when they're going to a bank. So in the case of an organization that's borrowing money from the bank wants some assurance that there's been some questions asked about the financial statements, and the accountant who's preparing them has to do a little bit more due diligence in preparing them and providing the financial statements. And then the third level, which is in my world and probably in your worlds, it's very rare. Typically, companies that get audits are public companies. Companies where there's multiple shareholders tend to be larger. I guess nonprofit companies typically have to get audits as well. But those are the three levels. And what happens in an audit is basically they do testing to make sure that all the accounts are recorded properly, and there's some third-party verification of the statements and an opinion. Usually, there's an opinion that's provided that the financial statements have been audited and are prepared in conformance with accounting principles.
Okay. Daryn, you kind of made it sound like accounting principles are sort of a rules-based system and pretty easy to follow. But every once in a while, we hear about big firms. More recently, KPMG was in the news about potentially a lawsuit filed against them for bridging finance. And I'm just wondering how, if the accountants are following the rules, how do they get themselves into hot water in their reporting of these financial statements?
Yeah, they're people.
Well, like Kraft Heinz got in trouble not too long ago, right? You know about this, Kim?
No, I'm excited to learn.
I want to say it was like last quarter or something, or maybe it was longer than that. Whatever. They were overvaluing some assets, including the goodwill. This was post merger, when Kraft and Heinz used to be separate and they joined together. And so anyways, they were overvaluing that asset of goodwill, which appears on the balance sheet. And, and for Kraft Heinz, they've got tons of really, really well-known brands that both of those brands had owned and now own together. And so they got in a little bit of trouble and got their wrists slapped, got some penalties, I think. And Daryn, do you know, am I the only one here that knows about this particular instance?
I don't, but when I started in this profession as a CBB, it was around 2003, and it was shortly after WorldCom, or it was Enron blew up. And at that time, they brought in the IFRS, the International Financial Reporting Standards. And what happened at that time is exactly what you said. There was a lot of off-balance sheet liabilities that they didn't show up on the financial statements. And so nobody saw them like what was happening. And it actually, event created it was a boon for our profession, because what ended up happening is they made it a requirement for financial reporting that goodwill be measured for financial statements regularly. And so and at that time, a lot of people were really getting into this profession because the accounting firms were all doing valuations on. So, for example, if KPMG was auditing a company, they would hire Ernst and Young to kind of test or quantify the goodwill on their balance sheet, and that didn't happen before. So there was kind of for a while there was kind of a push towards having valuators more involved in the financial reporting process in order that assets that are on balance sheets could be reported at fair values. And so that's and when you hear these things happen, these big blowups, they tend to be pretty big. Like, we're not talking a couple $100 disappearing from the till. It's huge amounts of money that gets wiped right out. So it's and that's why I said, like earlier, of the three types of classes of occupational fraud, financial statement fraud by far is the one that has where the biggest losses happen. Yeah. So I thought what I'd do is kind of talk about some things to look at in financial statements and understanding that the limitations of the compilation reports or compilation financial statements, and understanding that in most cases these numbers aren't independently verified. So sometimes you have to be aware of that, not just take things that are in there at face value. So I think I've got another slide. I can't remember if I put on that. You put on that slide before the category or the categories of financial statement fraud. They kind of fall into 5 buckets, and one of them is improper asset valuations. It's kind of like what we talked about before. And I'll just give you a little story on. I was doing a valuation, and there was a competing valuation, and it was really simple company, just held a bunch of equipment, and there was actually a helicopter that was owned by this company, and that's all it owned. And you think, oh, it's pretty simple. And I think what you see is, like, a lot of people say, okay, well, the value of this company is just retained earnings, or it's just assets minus liabilities. Problem with that is on a financial statement, you have the assets recorded at book value, which basically means it's cost minus an allowance for depreciation, and the value goes down over time according to a formula. But a lot of assets don't go down in value. In fact, they go up in value. And in this particular case, we saw pieces of equipment that after the fact, we knew they were sold for significantly more than the book values, right? So when you're seeing, like, the property and equipment schedule on a notice to read or financial statement, you really have to look at what those assets are and figure out whether or not book value is a really good proxy for those assets. And I think even now today, I'm hearing people, for example, if you want to buy a pickup truck, it's really expensive. So, if somebody bought a pickup truck 3 or 4 years ago, for accounting, it's probably worth next to nothing, or it's probably half of what they paid for it. But in reality, it probably is, it would sell for probably more than what they paid for it. So you always have to, be careful of, and a lot of business evaluations, we make that assumption that the book value is equal to fair market value. And I think that's one thing you have to be careful with, right? And that's where you can be led astray with financial reporting.
I have a quick question on this, and maybe it applies more generally too. Is there an element of intention here? if you're reporting it at book value, but you're not aware that that asset has appreciated, I mean, that might be part of your business. You're supposed to know that, but maybe you just don't know that there's been a huge surge in the in the price of helicopter parts.
Yeah.
Is there a subjective element to that and like the intention of fraud?
No, you're absolutely right. And when I'm talking about fraud and misstatement of financial statements, maybe I'm not. Maybe there can be fraud when there's misstatement, but sometimes it's just this is following the accounting rules, but it's not accurately reflecting the value or financial position of the company. If that makes sense.
Yeah.
And that's why I mean you have to be careful with financial statements and understand what the rules are. And the rules could lead you down the wrong road because book value and fair market value of an asset might not even be close. Right?
Yeah.
And you'll see that. Like I see that often. And another case, another thing that you'll see is when somebody buys an asset, what they can often do, they're motivated to treat it as an expense rather than put it on their balance sheet and capitalize it. And the reason is they can write that off for taxes. So it just, goes, equipment, we bought a computer, just expense it, right? But it should actually go on to their balance sheet and get capitalized. And the problem with doing that is like if you're capital or if you're expensing items that should be capitalized, your company has a lot more assets than what you're actually reporting. So people typically try and expense a lot more than they capitalize for tax reasons. And it might not be deliberate to create fraud, but what happens is you get a distorted your balance sheet becomes distorted because half of the assets that the company owns is not on the balance sheet. And I'm dealing with this in one case in an arbitration right now where like this company has no inventory or no assets. And I know they have that, like they have to have that. But that's just the way the accounting's been done. So, I mean, you have to ask those questions and find out what assets do you actually use in this business, right? So that's, that's a case where you have, the assets that the company owns they're not really reported properly on the balance sheet. And you'll see that a lot. That's something that you see kind of regularly. The other type of financial statement fraud is in improper disclosures. And a lot of time, if a company is dealing with a related party, there should be a disclosure that they are dealing, they've sold product or they've bought product from a party that's related. And then those, the transactions happen at, fair value. But in a compilation or lower level assurance, you don't really get those disclosures, right? So who are the customers buying stuff or selling stuff? Are they related? And are these transactions actually happening at fair market value? And I was involved in another litigation matter where there was two companies and one was renting equipment from the other, but it was really kind of like you can set that rental rate at whatever you want and just kind of move the profits back and forth between the two companies, right? And in this case, there was disclosure on that. But in a lot of cases, with a compilation or notice to reader, you don't have that requirement for disclosure, right? So, and sometimes people will set up shell companies. This is another scheme where, they'll set up a shell company. And there's actually a fraud that I know of from an accountant that I work with. And one of his clients, a relative, set up a shell company, invoiced the operating company of the shell company. So no one thought of it. And then they were just paying out this money to the shell company that was owned by somebody in the company, right? And that actually, I think, happened to AMA somebody set and defrauded AMA for millions of dollars over a period of time by just creating fake vendors, right? So, so in the, part of controls in it, in deterring fraud is you want to set up an arrangement where you have approved vendors, and nobody gets on that list until there's until they've been approved as a vendor and met certain requirements. And I'm actually the treasurer for the collaborative law group, and that's what we do. After learning about this, I actually set up a vendor list, and so we can't electronically send money out to anybody until they're on that approved list.
Oh, okay. Oh, that's interesting. Yeah.
Yeah. Yeah. It's a biggie, and it's one that stings. Yeah.
So like, what about don't we often have government scandals based around, like I can think of Trudeau had some issues with the charity, and we had Jean Chrétien have issues with some kind of government contract being awarded to some organization that, wasn't exactly above board. And usually, isn't this that type of, would that fit into that category, or is that different? Or
well, that falls more into the corruption bucket than the financial statement.
Right.
But that's kind of using your position, to be able to influence who gets contracts and take kickbacks, and paying out salaries to people who are related that may not be commensurate with what they do, like those kind of things.
It's nice to know that the government can commit fraud and basically get away with it.
Yeah.
Right. Because like last I checked, Jean Chrétien didn't go to jail, and it was a big enough scandal that he stepped down as being prime minister, and Paul Martin took over because of that scandal.
Yeah. Well, you don't even have to look too far. Like, I think it was ATCO Electric that just got sanctioned for a bid rigging scandal. It was something to do with the bidding system wasn't above board, and they got awarded some contracts that so it's common, and just how contracts are awarded and those what do they call it, I'm trying to think of the word for it, procurement fraud.
Yeah.
So if a big organization needs service, or government needs service, how do those contracts actually get awarded? And, there's sometimes corruption around that, how contracts get awarded. And so it's a huge, fraud is a big universe, and you can talk about all these things in depth. But, back to financial statements, the fourth category of financial statement fraud is fictitious or understated revenues. And again, sometimes there's an incentive to either reduce revenues or increase revenues. And the next thing is, which kind of talks about, is about timing differences. So, if I want to lower my income, one of the things that in a particular period, one of the things I would be motivated to do is push my income into the next reporting period, right? So maybe sandbag, just wait till report. So expenses and the revenue and expenses don't align with the period that they're actually earned or spent, right? So, one of the ways that you can kind of see that is, maybe a company, they have all their, they don't have, any revenue for the last couple months in their fiscal year. And then all of a sudden in the first part of the next year, there's a huge spike in their revenues for some. So, there's ways that people can, massage the timing of revenue so it falls into different reporting periods. And so again, your income statement isn't fairly reflecting the actual financial performance over that period.
Is this why somebody created that business disclosure? I think it's called Sweeney or something like that, where lawyers start to suspect that a business owner's maybe getting creative with their money. So the business owner is required to indicate their expenses, income, and provide a lot of disclosure. Is that where this all comes from?
Yeah, that's a little different, but it's related for sure. Yeah. And, because if you're, and I guess that would talk about, that's more like fictitious revenue and expenses. Because, if you're looking at a company's financial statements, you would expect that all the expenses that are reported are business expenses. But what happens is people, and if we're all proprietors, we probably all do this to a degree, is we'll throw our cell phone bill and we'll, maybe put some mileage in there and, maybe some hockey tickets and, maybe some meals and entertainment. And some people are some business owners are very careful not to do that because they want the financial statements to be clean. But in other cases, people want to throw as much personal stuff through their company financial statements as they can because they end up paying for personal expenses with pre-tax dollars. So rather than have, if you have let's say a hockey ticket's $100. Well, if you pay for it through your company, it costs you $100. But if you pay personally, you have to take $160 out of your company, pay personal tax, and then pay that $100. So there's an incentive to pay for these expenses through your company from a tax perspective. So the SWEEZY disclosure is a requirement that people outline their any personal expenses that the company pays that confer a personal benefit onto them. And the SWEEZY disclosure is an interesting one because it's, in theory, that's what should happen. People should disclose it, but I kind of find that it doesn't really happen. And it's tricky, but it's a hassle. It's a big deal. It's a hassle. Yeah, totally.
And then they'll get their accountant.
Yeah, and then they'll get their accountant to do it.
Yeah,
and their accountant wants nothing to do with it.
Right.
And the accountant doesn't really understand what we're looking for in the first place.
Right.
Yeah.
So that's what it is. It's just like, okay, well, are these really business expenses? Are they personal expenses that your company's paying for? And that's what that disclosure is trying to uncover.
So most of the time, I think, most of the time it's somebody with just a small business, and most of the time it's like, in my experience, it's like, okay, add back the cell phone bill, add back the meals expenses, maybe, and a few other things. Maybe their company's paying rent. That could happen, right? They could live where their company's office is located or something. There's things that CRA will let them write off, and they're not offside CRA's rules, but they're getting that personal benefit from. But usually it's not a huge amount in my experience. But we're talking most of the cases. If you get someone who's really sophisticated and is really trying to, manipulate the situation, then a company with a lot of assets and a lot of revenue that is buying a lot of significant luxury items and holding them on the company's books, then that's a little bit of a different story.
Yeah. And sometimes, it's a little bit of common sense. You can kind of see, somebody might only be taking $80,000 personal income, but you can see that their lifestyle, they go on a lot of trips, and, they, seem to live at a higher level than what the personal. And so in those cases, you can kind of recognize it. But you're right. It tends to be smaller companies where there's kind of one owner. Once you get into multiple owners, you see less of that because, somebody, the other partners wouldn't be too happy if one of the partners was using the company as a piggy bank. So generally it's, you're kind of owner managed one shareholder type of companies where that really becomes an issue. And it can be, I've seen cases where it's significant enough that it makes it moves the needle on guideline income. That's for sure.
Mm-hmm.
So is there more good people than bad people, or like in your?
It's a very philosophical question, Kim.
Well, I want a juicy bit. I want to know, like, are business owners in Edmonton like fraudulent for the most part, or are they all trying to do the right thing?
Well, I guess like you always, sometimes I'm joint engaged, which is good. But, a lot of times you're, and from as being lawyers, you're getting one side of the story. Right. So, and usually one party's mad at the other party. So you try not to get tainted and, with that perspective. But yeah, sometimes, sometimes people cheat for sure. It happens. Yeah. So I guess what I also, now that we've kind of touched on some of the types of financial statement fraud, I thought we'd kind of talk a little bit about ways that you can detect it. And do you have that? There is that one slide, and I think it's called vertical and horizontal financial analysis.
Yes, we have that. It's somewhere, Daryn. I'm looking for it. Vertical and horizontal.
It's actually a picture.
Okay.
Yeah.
Here it is. Okay, now I just have to find it. There we are.
Yeah. So what vertical and horizontal analysis is? It's expressing the income statement balance sheet items as percentages rather than dollar amounts. Okay, so you'll see what a vertical analysis is. It refers to it's a practice of common sizing all the balance sheet accounts as a percentage rather than a dollar amount. And what that does is it allows you to actually, I'm going to back up. I'm going to talk horizontal analysis first. So horizontal analysis allows for changes in individual financial accounts from one period to the next. So you'll see, like on this horizontal analysis, what you have is it shows the percentage change in accounts from one period to the other. So for example, you can see this particular company, it had a change in gross margin of 20%, right? From year one to year two. So what that allows you to do is see how things change. And what we typically do in evaluation or even a guideline income calculation is we express all the accounts as percentages or have the percentages beside them. And what it allows us to see is if, for example, we see meals and entertainment, it's usually like 1% of revenue and it jumps up to 10% of revenue. That's something that you drill down and ask about, right? Like, why was there this, big jump in this expense category over this period of time? Or why is your gross profit, because your gross profit margin you expect to be kind of constant, but when you see them jump up, or be really volatile, sometimes you have to ask questions. So doing the expressing the individual accounts as a percentage, it allows you to kind of benchmark, for one thing, against companies that are in that industry. So for example, if just as an example, electrical contractors or plumbing companies, typically they have a gross margin of 12%, and the company that you're looking at has a gross margin of 2%. Well, like what you can kind of see where maybe this is an anomaly, or certain categories of expenses are a lot higher or lower than what you would expect from the industry. It allows you to kind of, gives you some tools or some way to kind of identify red flags.
What do you do about black swan events like a pandemic? Because it's going to screw up all your trends.
Yeah, it does for sure. Yeah, and that has made things a little bit more difficult for sure. And so, just because like a lot of things have come to a standstill, and that's why I typically like to for like especially in this period, look back as many years as you can, even before the pandemic, to see kind of what the ratios were then versus now. And sometimes there is good reason, like business conditions change, but sometimes you'll see certain things, certain expense categories, meals and entertainment as an example. Maybe why is it all of a sudden gone way up? Or travel is now way up and you never had any travel before. So doing the horizontal or the vertical analysis allows you to see, kind of how much is in each bucket and, what's typical. And then the horizontal analysis allows you to kind of look at the company over different reporting periods and see changes in those expense categories. And that gives you, kind of gives you an indication if, there might be something wrong or just, the reporting might not be correct. And, like I said, I was dealing with, one company where I just knew that there had to be inventory and capital assets and they didn't show any, right? So like the balance sheet's not right. So it can be used, like this kind of analysis can be used for, for benchmarking and again, looking at trends in the business, over longer periods of time.
Daryn, who would hire you to look at this type of stuff? Is it mostly in your line of work, family law lawyers, or you mentioned before that sometimes other accountants will reach out to another accountant to look things over and review? Where does your business come from? I guess it changes all the time. I have been doing, in the last 5 years, family law has become a bigger and bigger part of my practice. So, I have, I would say maybe 50% of the work that I do is family law related, either valuations, appraisals, or guideline income calculations. But I also do, I've been involved with different shareholder disputes. A lot of times exiting employees, shareholder employees terminated without cause, and that kind of thing. Commercial transactions. I've done work for banks, where they've asked me to do valuations. So, it's not, I think with guideline income there, you have to look closely at the financial statements and how things are reported. Because again, one of the things that we don't, I think, look closely enough is at the cash flow statement of a company. And with a compilation financial statement, usually a cash flow statement is not included, right? But I actually think it's really important because, for example, you can have a company where, the revenues are really going up and the income is going up, but the cash flow might not be coming in because, their accounts receivable is going up and their cash is going down. And there was actually, it's a file that I'm working on right now. I was a court-appointed expert. And the issue was from the data separation to the data trial, the judge wanted to know, has there been money removed from, in this instance, there was a few different companies. Was there money or assets removed from the company? And you really wouldn't pick that up from the income statement, but you really could see that on a cash flow statement, because the cash flow statement records things like, repayment of shareholder loan,
or, repayment of debt. Like, for example, on a income statement, the income statement doesn't take into account principal payments on debt, right? But it's still the cash from the company's going down to pay that debt, but that's not recorded. The interest is recorded as an expense, but the principal payment is not. And the other thing is like capital assets. If a company buys a capital asset, it goes on their balance sheet, and it's kind of capitalized or capitalized over sometimes a long period of time. But there's a real outlay of cash at that point in time. So the income statements don't really reflect what's actually happening to the cash of the company. And so I think sometimes it's valuable using your balance sheet and income statement they have to kind of create a cash flow statement. So you can actually see what is happening with assets, with debt, repayment of shareholder loans, dividends, and so forth.
So if I was a business owner and I was getting divorced and I Google how to hide assets and money from my spouse, the question is, I'm going to pull up some good stuff maybe and some bad stuff. How easy is it to get to hide something from a guy like you? Like, is it next to impossible, or is it possible?
And if possible, how?
Yeah, it's, it kind of talks about that Sweezy disclosure a little bit. It's how much does a client really want me to drill down into this? And obviously there's a cost to doing it, right? And so it becomes kind of like, I'm sure that there's a lot of stuff that, people don't catch, I think, so it's, I guess it just depends on, the investment that somebody's willing to make to try and catch this, catch something like that. And, are they getting financial experts involved? Or, what happens sometimes is people get their accountants to look at stuff, and, the accountants have a different training than I do. I'm actually not an accountant. My training is completely different. So, but, a lot of times accountants are the go-to for these kind of matters. And I sometimes they're the right people, sometimes they're not, right? So you just hope.
So if you're hired, like if somebody's willing to spend the money to hire a professional, like we're probably going to uncover the seedy stuff, right? Yeah, you should. And, like if we want to look at the general ledger and start asking questions, well, it becomes a time consuming process, right? And so it becomes kind of like, again, what is the potential risk versus return of going through kind of a forensic analysis? And, how much money are we talking about? And how certain are you that this is happening? Because sometimes you have to cut it off. Like if it is a small company, are you going to catch every little expense that's personal? Probably not. But, how material is it? Right. Yeah. But, if the numbers are bigger, then, you got to make that a bit of a judgment call as to how much you want to, if you suspect something's wrong, how much you want to invest to, and how much time you want to commit to, to figuring that out.
Yeah. I've certainly had that conversation with clients before where they feel pretty certain that, there's no assets now because their spouse has, moved them offshore and somewhere else, or, given them to a sibling, whatever. And the documents that are provided to me, which aren't a huge amount, like we're talking 6 months of bank statements, right? So if it happened before that, I wouldn't see anything in the bank statements. But, I have that conversation where, okay, like they've provided a reasonable explanation as to why what you thought was there is not there. what do you want to do about it? Because you may be right. Like, I can't sit here and tell you that for sure this person hasn't done anything wrong with the money. It's very well possible that he has, but he's not telling us he has. And they've provided a reasonable explanation for what's happening. So if you want to pursue this further, then we have to look at, bringing a court application to demand further financial disclosure and, perhaps engaging a professional like yourself who's going to like really dig through the numbers to see what they tell us. And, sometimes it's not worth it for the client to do something like that. So I suppose to answer your quick question, Kim, in a roundabout way, is it possible? Yes, it's possible. Should you do it? No, you shouldn't do it. And because if you get caught, it's just so bad. And the more money it is, the worse it's going to be for you.
We didn't talk about that. What happens if you get caught trying to do some kind of financial fraud?
Well, I guess in the financial or in the family law context, you can talk about what happens. I don't think it's good, but I mean, you can end up in jail for something like that, right? So, and I guess what you said, Evan, you're right. Like sometimes it's maybe not worth going through a full-blown, forensic accounting exercise, but sometimes it's obvious and there's some low-hanging fruit.
Mm-hmm.
Right. And, in this case with this fellow I mentioned at the start of this discussion, who was defrauded out of almost, I think it was like over $500,000. Like there were some things out there we could identify really well without even doing a lot of work that this guy would, like we could substantiate a charge pretty easily. So, sometimes there is, you just kind of you pick the low hanging fruit and you go after that to, establish that the other party is not credible. Right. And then maybe that's all you need to do. So it's kind of just like, what is the scope of, kind of what you're trying to prove out by hiring an expert. And if you're clear on that, maybe you can save some time. And it's not such an expensive exercise. It's just kind of, identifying where, a misstatement may have been and, proving that out.
I think most of the time in the family law context, it's kind of funny because I think most of the time when it comes to finances, they all of a sudden give their ex-partner a ton of credit for sophistication when it comes to financial matters.
Yeah.
And it's just unlikely. It's just unlikely that this person would have the foresight to do it, to just get rid of those assets in such a way that you would have to go back years to find evidence of it. And that they did it in such a sneaky way that it would, it's like most of the time it's going to be like, you look at the bank statements and it's like, oh, we were getting divorced and now he transferred this $50,000 to his brother. And there's no explanation. Like most of the time it's going to be something like that because people are not that sophisticated. They're just, unless they do something like you do and they work with something like this all the time, you could probably figure out a good way to commit fraud because you've seen a bunch of ways and you know what people are looking for. But beyond having that level of sophistication, like, maybe if you're dealing drugs and you use the drug money somehow, get it into account that no one knows about and buy Bitcoin with it, maybe.
Yeah. And, unfortunately, it's a scenario where, trust is broken down and, there's been trust on different levels and, that person is just given trust to that person with the finances. And because the trust is broken down in this area, it's also broken down on the financial front. And that one party has more knowledge than the other, right?
Yeah.
And
most of the time you see this kind of situation where it has been the one party that's taking care of all the finances. And so, and like, maybe that's just kind of a public service announcement for people that, in a situation where they're getting separated or maybe not yet, but things are not going well in the relationship. Like financial transparency can go a long way and not just about saving the relationship. Like when the relationship breaks down, if you have that financial transparency, it's going to save you some hassle, because if you've dominated the finances, you can't then complain when the other side has zero trust about what you've done with the finances, and now is like making the court process take a lot more time and effort. Like, it's because you haven't been transparent about finances that's costing you now more money than it needs to. Even if there's like nothing that's wrong that's gone on. And because you're right, Daryn, it's the trust is broken. And when they lack any knowledge whatsoever about the finances, they're most of the time they're going to suspect the worst.
Yeah, absolutely. Which is not to say that this doesn't happen though as well. I've been adjacent to a few cases where there's definitely been dissipation or some serious malfeasance.
I heard you reference helicopter parts. Heather, you referenced helicopter parts. I heard about.
No, that was Daryn.
Oh.
Yeah, that was Daryn.
Well, I happen to know secondhand about someone who was trying to hide a helicopter in the separation, and they parted it out and tried to sell it, but it came.
My point there was the helicopter was on the books for $5,000, right? And that's the right way to report it for accounting,
right? But maybe you could sell it for more than $5,000. Maybe you could sell it for more than a used truck.
Well, I don't know if I'd get in a $5,000 helicopter.
Right.
I think what I've been kind of thinking about this conversation that underlies that idea of trust is that, there's like trust between you and the other party when you're talking about divorce, but there's also a lot of trust between a business owner and their accountant, their bookkeeper, their employees, all of that kind of thing as well. So I have been involved in a case where the divorce led to the discovery of stuff that was going on within the company that was the bookkeeper causing problems and not doing proper accounting and money going out the back door. And, fraud happening basically, or theft from the company. So, as a business owner, or even as someone who is married to a business owner, even if this is not your jam and your most favorite subject, it's probably important to, learn about these things, how a balance sheet works, what it looks like, why your accountant is putting this number on this side of the balance sheet, and why they're reporting things this way, so that you can monitor your own situation as well. Because I think, there's a lot of different elements of trust. And as Daryn has pointed out, there's a lot of room and areas here where things can either have some subjectivity or opportunities for downright fraud to be happening.
Yeah, and it's kind of in organizations, it's about setting up controls. For example, you don't have the same person issuing the invoice is writing the check, and just little things like that, right? Just setting processes up, and understanding where your exposure is.
Yeah,
is there a place? Sorry, Evan, you go ahead.
No, go ahead, Kim.
I was just, as soon as Daryn brought that up, I was curious if there's a place a business owner can go to get a checklist of things that they should put in place, like you did with the Collaborative Law Association in terms of vendors. Does that exist?
Oh, yeah, 100%. That's, there's people who specialize. And like I said, within like the CFE profession, there's all kinds of different things, people doing different things within this field. There's people like internal auditors that are fraud examinations, just looking at areas where they could be ripped off. And so there is definitely people that do that.
Would our listeners go to that association to find tips? Is that a good place to visit?
Oh yeah, the ACFE website is really good. They actually have really good. They actually publish an article or a magazine, comes out every. So they have just really good resources for helping people that are, trying to prevent fraud or detect fraud or whatever. And they've got a whole library of PD courses and, and so that's where I'm doing all my CPD right now is through this organization, because the courses are really, they're really user-friendly and convenient and interesting. And yeah.
Nice. Yeah, I think like what we've been talking about here for a lot of this is like financial statements, how to read a financial statement. What do the different line items on a financial statement mean? And another word for that is fundamental analysis, which I feel like, that's a useful thing for any adult to really understand, to have some kind of, they don't have to be an expert like you are, Daryn, about going way deep, but like having a good understanding of what a balance sheet is and the financial statements in general and how to read them and what that means. Because like, yes, we've been talking about it in the context of companies, but like you have a personal balance sheet, right? Everyone, like this applies to people, it applies to countries, it applies to companies, businesses. So if you are aware of what your own family's balance sheet looks like it would be good to know that, even if you're not the one that's mainly taking care of the finances. In fact, in businesses, lots of people that are in the business and manage the business don't do the finances, but they read the financial statements so they can keep the person who does deal with the finances accountable. And so if you're the one in the relationship that's not the money person, if you understand how to read a financial statement, then you can keep your partner accountable.
That's right. And, that kind of falls into Kim's world, and, having your, as part of wellness, like having your financial house together is, part of, budgeting properly, like you pressure off, right? If you got too much debt, you're just not your life in a way, you're not healthy.
Mm-hmm.
Uh-huh.
It's gonna be a problem. That's all. Yeah.
Uh-huh. Are there any particular businesses or sort of revenue amounts that might be targeted by fraudsters? Is there sort of a perfect victim or a common type of victim that businesses, might want to be concerned about and go, looking for some more help in preventing this in their business?
Well, I think it's everybody, but it's funny. I was in to see my dentist a while ago, and my dentist is actually a lecturer, or he's a professor in the faculty of dentistry at the U of A, and he says, "Oh, I should get you to come in and talk to like our class of graduating dentists, because apparently, like dental offices are like they get ripped off all the time." It's coming from somebody who's a practicing dentist, right? So I think it's just there was a big fraud at Grant McEwen where somebody fell for it's called a phishing scheme, where they send you a link or something, and people go onto this link thing. It's a bank website, and they give their information away, and then they get ripped off. But Grant McEwen sent money. They thought they were sending money to a contractor, and it actually ended up going to somebody else. So
I remember that it was like it was a lot of money, right? It was over $1 million. I can't remember exactly how much.
Yeah, and I think even as individuals, like
it was 11.8 million.
Yeah.
Oof.
And that is happening a lot to just average people, like these phishing schemes where they get a text and it'll be a link. Oh, go here to get your money deposited in your account. People click it, and it's like it's a total scam, right?
Law firms get hit with that too. They get what happens is people monitor, they hack into their email, and then right as the transaction's happening, they send a spoofed email to the law firm saying, "Oh, actually send the money to this account. We need to send it to this different account." And then, so the lawyer's due diligence is you never take due diligence that we have to perform on things like that to avoid this being victim to this fraud, is that you never take instructions over email. If you're receiving payment instructions, you're checking the email to make sure that it is from the person. And even if it is, that doesn't mean the other person could be hacked. And so the person could actually be, the fraudster could be sending it from their email account. So that's not enough. So you make it a practice of taking instructions over the phone only, and to a phone number that, you know, that you've called, that you've had before, that you've talked to the client before on. These are like the only ways to avoid that from happening, because you get instructions, you send out the wire transfer to that new account, or you deposit it at the bank into that new account, and that money's gone.
Yeah.
It's never coming back.
Yeah. Yeah. So just, it's everywhere, right?
I know, Kim, I'm going to bring up one of your favorite topics, which is insurance. Does insurance cover fraud for businesses? Is that special coverage that you would need? Like, would Grant McEwen have been covered by insurance for something like this that happened? I mean, that's a pretty specific question, but generally speaking, can you get insurance, or do you have any way of getting your money back? I assume that once it's gone for the most part.
I think you can get insurance. I can't really comment on that, but I'm sure that there is.
Kim?
It exists out there somewhere.
I mean, so this is another professional we need to have on our program. Business insurance is different from the life and accident and sickness that I do, but they're like, it would probably be tied into maybe errors and omissions in one line of business. Right. It might be tied into like a specific fraud insurance for another type of business, but I do not know. And
I can tell you, I can tell you what lawyers do, what lawyers have, but like that's very niche.
Yeah.
We have a few insurance providers, and some that cover things like phishing fraud and cyber security or cyber insurance. And of course, you know, if you fall subject to that fraud that I was just talking about, then, you know, you're going to have our liability insurance will cover that, because it's coming out of someone else's trust money. And so, but yeah, I mean, if you're just a normal person, probably not. Maybe if you're a business, you know, we need Kim's friend to come and tell us about that, whoever her friend is.
Yeah. Yeah, that whole cyber security, if I was to start my career again, I would probably go into that field.
It's pretty interesting, right?
Yeah, yeah. And
well, it's not too late.
I'm older than I look.
Just get we just need another COVID pandemic. And you're like, you know what? I'm going to get that accreditation. Yeah. When you were saying that, I thought, I wondered if Kim was taking notes, because Kim loves doing courses. And so
yeah,
when you described what you went through, I thought Kim was like, ooh, that sounds great. I could do that. I don't have any time, but I can make it happen.
Yeah. I think this is why Daryn and I get along well when we go for coffee at the Italian Center. We're on the same page, like gobble up, learn, get the information, give good answers.
Yeah, that's right.
I feel like Kim probably completed half the course while listening to this podcast. She's already registered. She did. Yeah, she's already studied the first module.
Oh, people are going to think I'm a nerd. I'm not a nerd. I just like to learn.
Nerds are the best. I love nerds.
You are a nerd, but you're a cool nerd.
I think
there's always something to learn, right? There's always something, and things are always changing. And
yeah. So, is there anything else that you wish we would have asked you about, Daryn?
No, it was good. This was a good discussion, and I look forward to connecting over a coffee or something with you guys.
Yeah. Now that COVID's over, we can do things like that.
Yeah. Yeah. So
absolutely.
So I enjoyed that, and congratulations on your great podcast.
Well, it just got a little bit better today.
Yeah, absolutely.
Yeah, no, it's really cool what you guys are doing.
Well, this has been such a fascinating conversation, and I'm looking back at the, the fraud tree, and I feel like there's so many other branches that we could go down and discuss. But this has been such a fascinating conversation.
And if you want another speaker to give you another perspective on this topic, I've got a really good person. He's a he's a former Edmonton police officer, and but now he just does fraud investigation on behalf of like estates, and he would give you a different perspective, because my perspective is, in the context of like my advisory practice, but getting somebody who's actually gone through and interviewed people, and I think would be so. Yeah, there's a lot of interesting branches that this profession, that a lot of interesting things people are doing in this line of work.
Well, send Heather his name and contact information, and we'd love to have him on.
Yeah.
And we need to go down more branches of that tree later, Daryn. So
yeah.
You can come back on and explore the family tree of fraud a little bit more.
Absolutely. Yeah. Well, I think my takeaway today is trust no one and have some robust processes in place. Is that the right takeaway? How about you, Kim and Evan? What are you taking away?
I agree. Get educated on financial statements. Doesn't matter if you're the business owner or not. Finance is not too complicated for everyone to figure out. I think that's a lot of times where people land. They think they won't ever be able to understand it, and they will if they give it a shot. Yeah,
I agree with Kim. Like, become familiar with what financial statements look like, and that, like, talking about learning things like that's only going to benefit you. You're never going to be like, oh, I wish I'd never spent time learning how to read a financial statement. That was a waste. Like, it's something it's so important and so connected to how the world works today. So to be able to perform fundamental analysis is pretty important.
Yeah, and as lawyers, you're trained in law, but there's a big financial component to what you guys are doing in a lot of cases, right?
Yeah, absolutely. In our cases and in our lives, many of us are business owners as well as lawyers. Yeah. So it's important in lots of ways.
Well, that's great. Thanks so much for coming on, Daryn.
Yeah, and I look forward to staying in touch with you guys.
Absolutely. Thank you so much for being our guest. We're looking forward to next time.
Okay. See you.
Take care.
Any information in this video is general information only and is not, nor is it intended to be, legal advice. Watching this video does not create a lawyer-client relationship. You should always seek the advice of a lawyer or other qualified professional for advice regarding your individual situation. While we take care to ensure that the information contained in this video is accurate and up to date, we make no warranties or representations as to the suitability, completeness, or accuracy of the information contained in this video. Any reliance you place on the information is at your own risk. Kahane Law Office, Merrick Law, Heather Malarick Professional Corporation, Evan Clark Professional Corporation, Evan Clark, Heather Malarick, and any guests will not be responsible nor liable in any way for any content, including but not limited to any errors or omissions in the content, or for any loss or damage of any kind incurred as a result of any content communicated in this video, whether by Evan Clark, Heather Malarick, or by a third party. Kim McDonald is a financial advisor with Raymond James Limited. Information provided is not a solicitation, and although obtained from sources considered reliable, is not guaranteed. The view and opinions contained in this media are those of Kim McDonald, not Raymond James Limited. Securities-related products and services are offered through Raymond James Limited, member Canadian Investor Protection Fund. Insurance products and services are offered through Raymond James Financial Planning Limited, which is not a member Canadian Investor Protection Fund. Raymond James advisors are not tax advisors, and we recommend that clients seek independent advice from a professional advisor on tax-related matters. Insurance products and services are offered through Raymond James Financial Planning Limited, RJFP, a subsidiary of Raymond James Limited, which is not a member Canadian Investor Protection Fund. When providing life insurance products, financial advisors are acting as insurance representatives of RJFP. Darkness of the dales dissipates, declines, because of he who turned water